And it's time for another Macro Monday where I get you ready for the week ahead in 5 minutes or less. Just a reminder, as always, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage on the week ahead, I'll put a link to that in the description of this video, and I highly encourage that you check it out. If you enjoy these videos, you will really enjoy our full newsletter. Okay, as always, let's start with our chart of the week. And here we have headline CPI in blue on the left axis and the average of the regional manufacturing prices paid series on the right axis in orange, advanced 6 months. So this week, which you'll see on the calendar, all eyes will be on the August CPI release. It's hard to see, regardless of what happens, how it could alter the odds of a Fed rate cut this month, given Friday's payroll report. More on that later. Still, it should provide some information on the inflationary impact of tariffs. Inflationary pressures are already showing up in the earlier signs of the supply chain, per the rise seen in this chart in the prices paid series from both the regional and national PMIs in recent months. So what's the takeaway? Leading inflation signals remain firm. Regional PMI prices paid indices point to CPI trending higher throughout the end of 2025 and into 2026. Tariffs are one of the drivers, but they're not the only one. So shelter inflation is running at 3.5%, medical costs are north of 4%, and utilities are in the low teens. Consumers may feel the squeeze, but the Fed continues to frame tariffs as a one-time adjustment rather than a persistent inflationary force. So this week, when we get the PPI report and the CPI report, we'll be looking to see if the trend in prices paid, the rise we've seen there, flows through to the headline CPI reading. In this instance, it will create an interesting juxtaposition off of the really weak labor market with the growing inflationary trends. And that leads us to the data calendar. As you can see, it's relatively light. We're going to start with Friday's payroll report. So for the Fed chairman, Jerome Powell, he effectively committed to a September rate cut during the Jackson Hole meeting, and last week's labor market data was exactly what he needed to follow through. So investors had already priced in at least 50 basis points of easing by December, and the data supported this expectation. The most forward-looking labor market gauge, the employment component of the ISM Manufacturing survey, remained stuck in contractionary territory with another sub-45 reading. And then in the payroll report itself, job openings softened, job cuts exceeded forecasts, the unemployment rate ticked up 10 basis points to 4.3%, and payroll gains came in at just 22,000. So overall, a really bad jobs report. In response, markets are now pricing in a small chance of an even deeper 50 basis point cut in September, but 25 basis points at this point seems all but certain. With that backdrop in mind, seems like almost 100% chance of 25 basis points in September. We'll be focused this week, as we mentioned, on PPI and CPI releases. Besides that, it is a pretty light week, but we do have some other key series that we like to pay attention to. We will be watching the NFIB Small Business Report on Tuesday. That always has a lot of interesting data series, see how businesses are handling the current inflationary and weak employment backdrop. And then we will also get our first read on September from the Michigan Sentiment Survey on Friday. So light week, we will be highly focused on inflation, especially given the expected upcoming rate cuts. And then also we have the two sentiment series, the NFIB and Michigan. That's what I'm going to leave you here today. Thanks for watching. I hope you have a great week. If you enjoyed this video and you're liking our Macro Monday series, don't forget to subscribe to the channel. Again, have a great week, everyone. And I will see you back here next Monday for another Macro Monday.